HMRC admits that the UK tax gap is £36 billion. That's the difference between the amount of money they say should have been collected in theory, but wasn't. And now HMRC is bringing in the most aggressive tools at their disposal to get what they think is rightfully theirs. First, the Connect system, which is supercharged with AI, tracks everything from your property and your bank accounts to your online posts. That means that if your declared income doesn't match your online lifestyle, you could be flagged instantly. Next, the Direct Recovery of Debt scheme, or the DRD scheme, is back after being suspended during the pandemic. HMRC can now order your bank to hand over any money that's allegedly owed, even from a cash ISA, if you owe them more than £1,000. And you only get 30 days to fight it and to contest it. And finally, from April 2027, banks will have to send your national insurance number with every interest on your savings report that they make. And that means instead of annual checks, HMRC can adjust your PAYE code in real time, taking income tax on your savings from your wages rather than just annually via a self-assessment. So AI, bank access, and real-time taxation. This isn't the future speculation, it's now becoming law. But the real question is, with the proposals for mandatory ID, are we now ready for HMRC's new powers? So in this week's video, we're going to look at these sweeping new changes that will change the financial landscape forever. If this is your first time to the channel, a very warm welcome. Hi, my name is Simon. I'm a chartered financial planner with decades of experience, and I've helped literally hundreds of clients as well as their families plan ahead with confidence by keeping more of what they've earned. So about 2 months ago, we published this video about the HMRC's new special powers, which are coming into force from April 2027. It actually went viral and it was watched over 250,000 times, and you left over 2,500 comments. So clearly this subject really touched a nerve. So I'm going to explain the other powerful, new and important changes that HMRC are introducing and how they could be affecting all of us going forward in the not too distant future. Well, first off, the taxman is changing. Now, for decades, HMRC has relied on annual tax returns, manual investigations, and slow-moving systems to collect what they think is owed. But now, there are 3 major shifts which are redefining how HMRC monitors, enforces, and importantly, recovers the tax. Now, together, they could transform the relationship between taxpayers and the state. And when you look at the backdrop, it's absolutely staggering. HMRC admits that the UK tax gap, and that's the difference between what they think should be collected in theory and what actually does get collected, is £36 billion. And that's equal to 4.8% of all tax liabilities. Now, closing that gap is the motivation behind HMRC's next chapter, and the tools that they're bringing in are going to be bigger, sharper, and far more intrusive than ever before. So let's break down the 3 big changes. There's going to be AI-driven surveillance through their Connect system. There's going to be the revival of the Direct Recovery of Debts, or the DRD scheme. And as I mentioned in the previous video, we've got the new National Insurance Number reporting rules, which are coming into force from April 2027. Now, HMRC's Connect system isn't new. It was launched back in 2010, and it's often described as a government's supercomputer for tax enforcement. It was built in partnership with BAE Systems. Connect cross-references billions of data points such as bank accounts, property ownership, land registry records, vehicle registration via the DVLA. It also looks at flight manifests, online marketplace sales such as eBay or Vinted, and even credit card transactions. But what's changing now is the AI overlay. Now, in 2024 and 2025, reports surfaced that HMRC is enhancing Connect with machine learning and even using AI tools to scan all of our social media posts. Just think about that for a second. All your Instagram photographs of a luxury holiday, your Facebook marketplace sales, your LinkedIn job updates, all of this can be cross-referenced against your declared income. If you're driving a new £50,000 car, for example, but reporting an average UK wage of £37,000, then the AI Connect system isn't going to need a human inspector to see that something might not quite be as it seems. And of course, AI can flag any anomaly automatically in real time. Now that means that more taxpayers could find themselves under investigation, now not because of a tip-off or an audit, but because the algorithm spotted a mismatch between your lifestyle and your declared earnings. It certainly feels like a very unnerving surveillance from a digital eye that never blinks. Now the second big change isn't about detection in this instance, it's more about collection. In 2015, HMRC introduced the Direct Recovery of Debts, or the DRD scheme. Now the idea was simple. If someone owed more than £1,000 in unpaid tax and refused to settle, HMRC could bypass court proceedings and instruct banks to transfer the money directly from the debtor's bank accounts. But after backlash from MPs and public concern over fairness, the scheme was quietly shelved during the COVID-19 pandemic. And if you fast forward to now, the DRD is back, this time under the radar as a test and learn rollout, officially relaunched after Chancellor Rachel Reeves' spring statement. So here's how it works. DRD will apply to debts of £1,000 or more. Now, before touching our bank accounts, HMRC must attempt to contact the debtor and even arrange a face-to-face visit if that's possible. Now, taxpayers will get a 30-day window to object to this before the funds are automatically taken from their bank account. Now, crucially, HMRC is required to leave at least £5,000 in the debtor's bank account to prevent a total financial wipeout and to make sure that they've got money for their mortgages, their bills, and their food. Now, on paper at least, these safeguards might look reasonable, but in practice, critics are calling this a draconian measure, arguing that it gives HMRC to play judge, jury, and financial executioner without the usual checks and balances of a court oversight. But it gets worse. It's not just your bank account that's under siege. The DRD scheme is also going to be covering your cash ISAs as well. So even your safe savings aren't going to be ring-fenced anymore. And that means the political messaging is absolutely crystal clear. The HMRC wants to target those who can pay but won't. And yet the power to dip directly into our bank accounts feels like a fundamental shift in the taxpayer and the state balance. So if you're finding value in this video about the extra powers that the HMRC now has, then please hit the like button and subscribe to the channel. It's free, it only takes a second, and it really does allow us to keep creating these valuable videos. Now don't forget to hit the notification bell as well so you don't miss any future content. Let me ask you a question. If AI is scanning your lifestyle and social media posts, is that a clever use of technology, or is that just spying and surveillance gone way too far? Let me know in the comments. Now, the third change is more subtle, but it's possibly the most far-reaching, and this is a subject that I covered in the previous video 2 months ago. Now, starting in April 2027, banks will legally be required to collect and pass on our national insurance numbers for all eligible savers. Now, right now, banks do already report savings interest to the HMRC annually, but the data is very, very messy. Now, records can be incomplete or mismatched, meaning the HMRC often only spots underpayments after the tax year ends. Now, that lag will force some taxpayers into self-assessment, or it could leave them with surprise tax bills several months later. But from April 2027, with national insurance numbers tied to every savings report, HMRC can now match interest income that's owed directly to individuals nearly and almost in real time. Now that means that PAYE taxpayers could see their tax codes adjusted mid-year with extra tax on their savings deducted from their wages or pensions each month. But it also means that self-assessment cases could be flagged earlier. Now, ISAs will remain tax-free, but they must still carry national insurance numbers against them to prove eligibility for their tax-free status. So in effect, This moves HMRC from an annual cleanup to continuous real-time oversight. So what once took months to detect could now be actioned instantly, where we're now going to have an always-on form of tax collection. So we're going to have AI and Connect to make detection faster and more automated. We're going to have the DRD scheme to make debt collection more aggressive with money taken directly out of bank accounts or your cash ISA. And we're also going to have national insurance number reporting from April 2027, making income tax collection on our savings interest easier and in real time. So for anyone on the margins, or even those making innocent errors, it's going to mean swift and brutal enforcement with very little warning. So I've linked a further 2 videos in this series, including the original viral video about the HMRC raid on our wages and why gifting your home to avoid inheritance tax or even care home fees could end up costing you everything. Thank you so much for watching to the very end of your time and for your patience as always. I'm going to see you all again next week.